Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Tonight in the markets, August ended this week and all the major stock indexes ended in the red for the month of August. And with a new month comes a new report on how the country did for jobs in August and how was the unemployment rate for last month. And with these job numbers, will a recession be inevitable or could we have possibly dodged the bullet? I'm Andre Laborde. We've got these stories and more on this edition of Wall Street Wrap-Up. Hi, I'm Andre Laborde, and welcome to Wall Street Wrap-Up on this Labor Day weekend, Friday, September the 2nd, 2022. I hope your week went well. For those who used to enjoy Game of Thrones, the phrase winter is coming, well, that may ring a bell. Well, the end of summer is just days away now, but last Wednesday, August came to an end, and unlike how it started, all the indexes ended in the red. Last Friday, the Fed Chair Jay Powell gave a brief 5-minute speech where he said he's going to do whatever it takes to bring inflation down to 2%. Well, this sent all the stock indexes down, and it just continued throughout this whole week. For August, the Dow Jones ended down 3.25%. The S&P 500, they ended down 3.5%, and the NASDAQ, they ended down 4.1%. Well, coming up on the show, we're going to be talking with Bob Dahl. Now, Bob is the Chief Investment Officer at Crossmark Global, and for those read Bloomberg or Barron's or Wall Street Journal, he's frequently quoted as he was this past week in the Wall Street Journal. Bob will be with us in just a moment. Well, this morning, the Bureau of Labor Statistics released their August jobs report, and it was called a Goldilocks jobs report. Why? Well, because it was not too hot and not too cold. August increased their private sector payroll by 315,000 jobs. And the unemployment rate did tick up to 3.7%, which is now showing what raising of interest rates will be doing by slowing the economy. And the labor force participation rate is now at 62.4%. Now, it's referred to as a Goldilocks because if it's too hot, then the market would feel that the next Fed meeting, they'll have to raise interest rates even higher. But if it's too cold, then it would bring a recession faster than possibly expected. Now, to even mix my metaphors, Goldilocks is going to have to thread that needle very carefully. Well, how did we do in the markets this week? All the major indexes were down with the major sell-offs occurring today. And this week, the Dow Jones ended at 31,318, down 3% for the week. And the S&P 500, they closed at 3,924, and that was down 3.3% for the week. And the NASDAQ, they ended at 11,630. That was down 4.2% for the week. Well, let's get to our guest this evening. Bob Dahl is the Chief Investment Officer at Crossmark Global, and he's here with us tonight. Hi, Bob. Welcome to Wall Street Wrap-Up.
Great to be here. Thank you.
Friday, at Jackson Hole, Wyoming, the chair of the Federal Reserve, Jay Powell, he basically threw a bucket of cold water on the stock market, and it's been a roller coaster of a ride all this week. Do you see that the stock market will still be jittery all the way until September for the next Federal Reserve meeting?
It could be jittery for much of the rest of the year, and jittery doesn't mean straight down, of course, just volatile. Look, you're right, the bucket of cold water. Remember, his prior public statement was after the Fed raised rates back in July, and his comments basically encouraged too many people to think they're close to finish. We may be hitting neutral Fed funds. Maybe after the turn of the year, they'll lower rates and pivot, as the word goes. And none of that made sense relative to the fundamentals. And last Friday, he came out with that bucket of cold water to kind of set the record straight. We're fighting inflation, he said. And if you ask what we're going to do after that, we're fighting inflation. And in case you forgot, we're fighting inflation. And you get the picture, and the markets didn't like it so much.
Yeah. Now, the Federal Reserve will never probably admit this, but what they don't want is, and what you're just saying is that they don't want the stock market to be running up. I mean, they want stocks to be going lower?
Yeah, what they want is inflation to come down. And for that to happen, the economy has to slow, which means earnings question marks and problems, which means a down stock market. I mean, they're not rooting for a down market, but they are rooting for the things that might cause a down market. And that's why the Fed chair in his we're fighting inflation said, and it might result in some pain for people. He's basically saying economic slowdown, earnings difficulties, maybe some layoffs, and maybe the stock market doesn't do so well for a while.
I read this week in the Wall Street Journal, you were quoted. I'm not familiar, like at Crossmark Global, you have, and I think it's your equity market neutral fund. And I hope I'm stating that one correctly. I'm curious as far as like, you were mentioning how, specifically that one, but y'all are shorting the market. Is it only in that fund, or do you think that a lot of your clients are shorting the market? So does that mean that you're going to be seeing the market, maybe the SPY or the S&P 500 going lower, much lower?
So I have the privilege of managing 4 different portfolios at Crossmark. 3 of them, large cap core, large cap growth, large cap value, are long only. We buy and we sell stocks. The 4th, the one you mentioned, is called equity market neutral. And that neutral means we're long 100 stocks and short 100 stocks. So we're not asking the market to go down. We just think on the short side, if we can identify stocks that are going to underperform, and on the long side, identify companies that are going to outperform, that's money in clients' pockets. And that's why that fund is up year to date, despite the stock market being down so much. Yes, so we don't mind when our shorts go down, is a shorter answer to your good question.
It's a good hedge. I understand. Yeah. I've got one of our viewers always writes me every week, and he's out of Florida. And this week, and because of what we're talking about, it reminded me, because he'll always tell me what he's doing. And he goes, and before I read what I read about your quotes in the Wall Street Journal this week, he said, Andre, this week I'm shorting the SPY, which is, for our viewers, the S&P 500. Now, that's one of our viewers out of Florida. But in that equity market neutral fund, you do long 100 and short 100. But do you think like a whole group of stocks, such as the S&P 500, will be the rest of this year, or within a certain time will be going further down?
So coming into the year, we do 10 predictions, and one of them is that we'd have a down year in the stock market. Our problem was valuations were way too high for an environment where inflation interest rates were moving up. Then, of course, we had that horrible first half. And then, as you know, from June 16, an important low, we had the big rally until the bucket of cold water last Friday. My guess is stocks are going to be volatile in both directions. I am on record to say I think December 31st, the stock market will be higher than it was on June 30th. But I'm not sure it's going to be by a whole lot, but we will end up having a down year for the stock market. And from here to the end of the year, there will be some stocks, unfortunately, that do go down.
Bob, that's a very good point, because normally, under normal circumstances, that when the market is down for the first half of the year, it will be up for the latter part of the year. So that's why what you were thinking, that by December 31st, will end up higher than June 30th, even though it may not be by much?
Yeah, exactly. It's a function of, well, we've got some difficult news, but doesn't the 20+% decline in the first half account for some of that? Take that into consideration. So that's why we're more optimistic, or I might say less pessimistic about half 2 than we were about half 1.
Yeah. Well, in July, we had a very good month in the stock market. And even if you can even say in the first couple of weeks of August, it was only until around the time of Jackson Hole, Wyoming, when the Federal Reserve Chair made those statements he did, that when the market started to go down and tank. Do you think that what we're seeing right now, which is more on a downtrend, is more of the anomaly, and we'll see a little bit more of the uptrend that we saw in July and early August? Or do you think we'll see more of what we've been seeing right now, and July and early August was more of the anomaly?
I think July and August was more of the anomaly. Well, I don't think there is a whole lot of downside in the stock market. the path of least resistance since that cold water, as we talked about earlier, is to the downside. Look, when the Fed shuts the door on relief or a Fed pivot or a Fed put, as people put it, the stock markets, oh my goodness, I got to worry now about the economy and earnings. And that's rarely good for stocks. That's the adjustment that's being made. And that's why we're seeing a lot of red on our screens of late.
We talked a little bit earlier about about stock markets, how the Fed doesn't really want to advertise it, and they really don't want to see stocks go completely down, but they don't want the euphoria that they have been seeing. Well, I'm assuming, and your thoughts about the housing market. Lately this week, as well as last week, housing has been certainly cooling down with higher mortgage rates. Do they feel the same way about the housing market? They want that to be slowing?
So yes, the housing market, as you know, housing in general is one of the most interest-sensitive parts of the U.S. economy. It is often the thing that starts going down first, and when we come out of recession, often the thing that goes back up first because it marches to the tune of interest rates. And with mortgage rates up, that activity is slowed significantly. Prices haven't come down a whole lot in the housing market, as you probably know. It's activity levels that have come down quite a bit, and there's probably some price weakness ahead.
Interesting, because so with the housing market, do you think that would also correlate to companies that are, looks like now, trimming their employees? You've got some major companies out there that are starting to cut some of their workforce. Is that the same way?
Yes. So we've had a jobs market, as you know, that's been very strong. In fact, we got this past week another report that says there are almost double the number of jobs available as there are people looking for work, which is a strong job market.
Yeah.
Now, that doesn't mean it's going to stay that way, nor does it mean that everybody's in that boat. An increasing number of companies are slowing hiring / beginning to do some layoffs. And as the economy slows, with the Fed operating the way they are, we're likely to get more layoffs. The job picture is a lagging indicator. It's one of the things that goes down last, if you will. So that it's still strong doesn't mean we're necessarily going to escape an economic slowdown.
What does it mean where, like, and I'll only speak for my area and for our viewers. I mean, you go into grocery stores, you go into many different stores and employment places, and you'll see help wanted signs. So they're looking for employees, but at the same time as what you're talking about, they want to slow down the job market.
Yeah, so the Fed can only raise interest rates. It's a very blunt instrument, as we talk about. They don't have a scalpel where they can go in and say, okay, I need to operate on jobs in this industry or that geography. It's a blunt instrument. So as they raise rates, their hope is that that slows economic growth, which slows down job growth. But you're absolutely right. We are still in a position, as I said before, where there are a lot more job openings than there are people looking for work. So that you're seeing those signs in lots of places is no surprise. And that's happening all over the country.
Bob, you bring up a good point, because like you were talking about, like what the Federal Reserve can and cannot do. They can raise or lower interest rates. And like with the bond market, they were, I want to say it was something like $6 trillion they pumped into the economy by buying bonds. So they can do these things. But there are certain things that their hands are tied. And I'm thinking of such as things that are going on in Europe, which is supply chain issues or other types of issues that are beyond their control. Do you think that these type of other issues, such as being able to manufacturers getting products and items to stores in the United States, how much of a crimp or of a problem do you think that is causing sales on companies that are releasing, that will be, let's say, releasing their earnings for the third quarter or the fourth quarter?
Yeah. It is definitely an issue, Andre. It stems back to the pandemic. Remember, when it happened, we didn't know how to spell coronavirus, so we shut the economy off. And in a little while, we turned it back on. And the assumption naively was that if I turn it off and it shuts down, if I turn it back on, it's going to come right back. And that's not been the case. It's been very bumpy. And that's what's caused these supply chain inequities, these supply chain imbalances, and the supply chain problems. They're beginning to get a bit better, but they still exist significantly. So part of the problem we have is not just demand related, which the Fed does have ability to exercise policy over. It's supply chain problems, which the Fed has almost nothing to say about. And so that makes their job even more difficult.
Do you think that because, like you were saying, that the Fed is totally helpless with the supply chain problem, that right now, and I want to say it's something like March or April was when they stopped buying bonds, mortgage and treasuries, of dumping money into the system that way. And now they're starting to take money out of the system since that time. Because they can't do the supply chain issues and they're helpless on there, do you think they should accelerate the sales of the bonds that they've been purchasing for the last 2 years?
So great set of questions. I go back to, I haven't poked my finger at the Fed, but I'm about to. Remember, they use the word transitory. Inflation is transitory or temporary. And they stood on that word way too long. That was the error in judgment, which has only compounded the problem. So now we have not only the Fed raising rates, but them having to deal with their balance sheet, which is, as you just pointed out, their need to reduce it, which means they have to turn around and sell some bonds. And on top of that, money growth, the supply of money, that growth rate has shrunk significantly. All of those three things put a dampener on economic growth. And when you have all three at once, it's uncharted territory. We don't have a playbook that we can go back to and say, back in such and so a year, we did this and then. And so we're all flying a bit blind, which raises the risk and uncertainty level a bit more.
When we talk about bonds, Bob, lately, and I want to say for the last few weeks, although it may have been a little bit longer, treasuries, normally the yield of a 10-year treasury is higher than the yield of a 2-year treasury because you get paid more if you hold that bond longer. But lately, and I say lately, the last couple of weeks, the 2-year treasuries are paying more than the 10-year treasuries, sort of like an inverse of the yield. And as you know much about this, is that when this occurs, recessions are normally occurring or will be going after that. Do you follow that type of a thought that when there's an inverted yield curve that recessions usually follow?
Absolutely. It is one of the warning signs out there. Now, an inverted yield curve doesn't mean we have to have a recession, but it is one of the precursors that typically say we might have a recession. Because of the strength of the U.S. consumer, a lot of cash on their balance sheet from the COVID days, money not spent or checks mailed to them by the government, a corporate sector that's in pretty good shape from a balance sheet standpoint, and the reasonably strong jobs market that we talked about a few minutes ago. Those things tell me if we're going to have a recession, it's probably going to be a mild one, and we might be able to escape one altogether. Now, I know that's Pollyannish language for a lot of people. A lot of people say inverted yield curve, recession, we just don't know when. And that's certainly possible, but I come back to if we have one, it's probably going to be mild.
We're going to catch up right where we're talking right now with Bob Dahl. Bob is the Chief Investment Officer at Crossmark Global. Don't go away. We'll be right back. Welcome back. We're talking with Bob Dahl. Bob is the Chief Investment Officer at Crossmark Global. So happy to have him. Bob, right before we went to a break, we were talking about the 2-year and the 5-year and the 10-year, the Treasury bonds with the inverted yield curve. Well, I'm curious, and we also you were talking about recession. You know, there's no real playbook, of what actually happens, although we can use history a little bit. And in the late 1970s, 1980, when inflation was so high, and Arthur Burns was the chairman of the Federal Reserve, and then followed by Paul Volcker. The way they were measuring inflation, and I'm dealing with housing, is a different metric than the way it is today. So I'm curious that if they used, and I've been told, and I'd love your thoughts on this, if they used the same metric today in 2022 as they used in 1979, 1980 and such, that inflation, which right now is about 8.5% year over year, would actually be much higher, like over 10%.
That's accurate. The problem with using those old statistics is our economy has changed, and the composition of what we as Americans purchase doesn't reflect what happened back then. We have a new basket, if you will. So, hey, look, whether it's 10 or 12 or 8, any of those numbers, not tolerable, and we have to bring it down. So we could quibble what the number is, but we all know all the numbers at the moment are too high.
We're talking about, that a recession is not inevitable, although it may be very possible. What would you do if you were sitting in that Fed board chair, and how would you go about continue to keeping interest rates going higher, or whatever you would do so that we would have what's known as a soft landing, which is without a recession, as compared to a hard landing that a recession would occur? What would you do?
So the Fed is certainly trying to engineer a soft landing, but I come back to they're between a rock and a hard place. The rock is we have an inflation rate that's intolerable. The hard place is, but if I operate too hard on interest rates, I could put us into a recession. They're trying to tread that simple in-between line, which is very, very difficult. Look, I think inflation has to be brought under control. And I'm not saying damn the torpedoes and don't care about the economy, but I'm glad the Fed chair last Friday finally put inflation as the number one issue. Get it out of the system, and then we'll worry about the economy.
Bob, there's a lot of people that may be getting close to retirement right now and are thinking about retiring, and of all times, we've got this recession that may be coming around looming. I was reading recently where Professor Jeremy Siegel of the Wharton School was saying that it's quite conceivable and acceptable to have maybe 10% of your portfolio and having meme stocks. And meme stocks, for our viewers, were stocks that really you don't trade on valuation, but just on like momentum, like AMC or GameStop and such. You deal with clients. What are your thoughts about having meme stocks in your portfolio?
So there are more people who lose money on those stocks than make money. You got to be in early to make money on those stocks. They are speculations, and you don't know when that momentum's going to run out of steam. So for my clients' money, I'm more careful and say, let's not go there. Let's own companies that we can get our arms around, understand their business, their earnings, their cash flow, their valuation, as opposed to speculating on something we don't know when the train's going to stop.
Bob, I can't tell you, and I'm sure you're the same way. I'll go to parties or get-togethers, and the two questions I get asked most about, because I would do this show, are what are my thoughts on weed stocks and crypto? Yes. Those are, and I'm sure when you go to other locations and parties too. With cryptocurrency, I read in the Wall Street Journal where there were pension funds, some state pension funds, particularly firefighters and police pension funds, that because of the cryptocurrencies had gone down, a lot of state pension funds were also heavily invested in that. Do you think also that crypto is a type of a location, a sector to put pension fund money in?
So my view is crypto technology, if I can put it that way, is for real. Mm-hmm. But we don't know the details. We don't even know how the government's going to regulate this part of the market. So we don't know who the winners and losers are going to be. So my view is that it's a speculative investment. And speculative things scare me because I can lose money just like I can make money. And people have made fortunes and lost fortunes in both those areas. Not with my clients' money. I want to be careful.
ESG. And ESG is environmental, social, I want to say corporate governance. if I've got my ESGs right. And right now, to some sectors, that's big. And for the most part, that means not investing in things like coal or fossil fuels and such. Well, there are some states that are striking back, and investment companies such as BlackRock or State Street or Vanguard that are big in ESGs that will not invest in these type of companies. Now, states' pension funds are not wanting to invest in not just those, but those other types of ESG funds. What are your thoughts on the ESG sector?
So I work for Crossmark, which is a values-based investor. There is some overlap, but there are a lot of big differences. ESG has to be defined well so people know what it is that they're getting into, and it grew so fast that there are a lot of question marks at the moment. I think it will come back, but maybe some retrenchment first. Know what you own and why you own it, as opposed to just jumping on a bandwagon because there's a trend out there.
What's the best investment advice were you ever given?
Yeah, other than buy low and sell high,
as compared to others.
Keep the long term in view. Look, if somebody has a timer, somebody asked me recently, what stock should I own between here and the end of the year? And my answer is none. In a short time frame like that, there's a lot of chance stocks can go down, not because of the environment we're in, any environment. You need to have a long-term time horizon. And when you do, take some risk. It's okay. Calculated and risks that you understand, but grow your portfolio for that longer-term retirement or kids' college education or whatever it is you're looking for. But buy low, sell high dominates.
Bob, I'm out of time, but I hope you come back. I thoroughly enjoyed having you.
Thanks for the opportunity.
Thanks, Bob. Well, if you've got a question about finance or a comment about the show, we would love to hear from you. Make it pithy or concise and write us at andre@wallstreetwrapup.info. Now for a look ahead for market information for next week. But first, what department did the U.S. Congress create on this day, September 2nd, in 1789? We've got that answer in just a moment. Well, what department did the U.S. Congress create on this day in 1789? The Department of Treasury. Well, next Monday, the markets will be closed for Labor Day, so it's going to be a 4-day trading day, a short one. Next week on Wall Street Wrap Up, we're going to be talking about your investment portfolio with the managing director of Morgan Stanley, Jim Spiro. Jim's got over 40 years of experience in bull and bear markets, and he can give us some advice and insights as where he sees the rest of the year to go. Next week, Morgan Stanley's Jim Spiro. And as a reminder, we do repeat the show on Sunday mornings. Remember, but the best way, set your DVR so you'll never miss an episode. And that is our show for this Friday, September the 2nd, 2022. I hope you enjoyed it. My thanks so much to Bob Dahl for joining us this evening. But as always, it's you. We appreciate you for allowing us into your homes tonight. Remember, follow us on all the social media on Facebook and YouTube and Twitter and WYES.org. So have a great Labor Day weekend. Have a productive week as well. I will see you next week for Wall Street Wrap Up. I'm Andre Laborde. Remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.